REIT dividends are payouts you receive from investing in real estate investment trusts, REITs. REITs are companies that own, operate, or finance income-generating real estate, such as apartments, offices, shopping centers, or warehouses. They are required by law to distribute at least 90% of their taxable income to shareholders as dividends, which is why they're a popular choice for income-focused investors. How do REIT dividends work? When a REIT earns rental income or profits from selling properties, it distributes a portion of that income as dividends to its investors. These dividends are typically paid out on a quarterly or monthly basis, depending on the REIT. For example, if you own 100 shares of a REIT that pays $1 per share annually, you'd receive $100 in dividends distributed throughout the year. Types of REIT dividends. Ordinary income dividends. The bulk of REIT dividends comes from rental income or operating profits. These are taxed as ordinary income, which means they don't qualify for lower tax rates like regular stock dividends. Return of capital, ROC. Some dividends may be classified as a return of your initial investment. ROC is not immediately taxed but reduces your cost basis in the REIT, which can affect taxes when you sell. Capital gains distributions. If a REIT sells a property for a profit, part of the dividend may come from capital gains. These are usually taxed at lower rates. Why are REIT dividends popular? High dividend yields. REITs are known for their above-average dividend payouts compared to regular stocks because they must distribute most of their income. Steady income. REIT dividends provide a reliable income stream, making them a favorite for retirees and income-focused investors. Real estate exposure. By investing in REITs, you gain exposure to real estate markets without the need to buy or manage physical property. Example of REIT dividends. Let's say you invest $10,000 in a REIT with a 5% annual dividend yield. This means you'd earn $500 in dividends over the year. If the REIT pays dividends quarterly, you'd receive $125 every 3 months. Taxation of REIT dividends. Unlike regular stock dividends, most REIT dividends are taxed as ordinary income. For example, benefits of REIT dividends. High income potential. REITs often provide some of the highest dividend yields in the market, making them ideal for generating passive income. Diversification. Investing in REITs gives you exposure to real estate, an asset class that often moves differently from stocks and bonds. Accessibility. REITs are easy to buy and sell on stock exchanges, offering a hassle-free way to invest in real estate. Drawbacks of REIT dividends. Tax inefficiency. Ordinary income dividends are taxed at higher rates than qualified stock dividends, which can reduce net returns. Interest rate sensitivity. REITs can be impacted by rising interest rates, which may affect their dividend yields and share prices. Market risk. REIT prices can fluctuate, so the value of your investment might decline, even if dividends remain steady. REIT dividends are a fantastic way to earn passive income while investing in real estate. They're ideal for those seeking consistent payouts and exposure to the property market, without the hassle of owning and managing physical properties.